today we are conducting a clinical post-mortem on a high-yield fund that imploded. Our purpose is to dissect its irresistible promise, expose its fatal flaw, and understand the devastating fallout for the investors who are caught in its collapse. This is the anatomy of a failure.
This quote captures the essence of the experience. It is the sound of trust being obliterated. It's the feeling of betrayal that accompanies a catastrophic financial loss. Our objective here is to understand, with precision, exactly how this was allowed to happen.
Our analysis will proceed through 6 distinct stages. We will begin with the irresistible lure, then uncover the fatal flaw. From there, we follow the investor investigation, which leads to management under scrutiny. This culminates in the final crossroads, forcing us to ask, is this an unwinnable game? So, let's begin. Section 1. The irresistible lure. Every financial trap you'll find starts with an alluring promise. And for this particular fund, the bait was incredibly powerful. The promise of a high and, importantly, a very frequent income stream. The value proposition was as simple as it was brilliant. A steady stream of cash delivered to your account every single week. Now, this wasn't just a financial strategy. It was a marketing masterstroke. It tapped directly into the deepest desire of the retail income investor, the need for consistent, predictable cash flow. Section 2. The fatal flaw. Of course, behind that beautiful, alluring promise of high weekly income was a very ugly reality, and that reality was the systematic destruction of investor capital. And here it is. This was the core problem, the #1 sin of any income-focused strategy. The fund was not actually generating real yield from its investments. It was simply taking investors' own money and handing it back to them, all while their principal investment was rapidly shrinking. This analogy really says it all. The promise was high weekly income. The reality was getting paid from a piggy bank that was simultaneously being smashed with a hammer. Even though you saw cash coming in, the combination of high payouts and a falling asset value guaranteed only one outcome. Your total net worth was being destroyed. Those weekly payouts acted as a potent psychological distraction. You could even call it a financial magic trick, expertly designed to keep your eyes focused on the incoming cash, to mask the simple, brutal fact that your initial investment was disappearing right before your eyes. This quote really pinpoints the psychological trap at play. That weekly dopamine hit of cash landing in your account feels good. It creates a powerful illusion of success. And that illusion completely masked the financial decay that was happening just beneath the surface. When the payments finally stopped, the reality check was absolutely brutal. Section 3. The investor investigation. As you can imagine, as the losses began to mount, investors were forced to change. They shifted from being passive dividend collectors into active, almost forensic investigators, absolutely determined to find the source of the rot. And what did this collective investigation uncover? Well, it zeroed in on 3 key problems. First, the underlying stocks the fund held were far too speculative for an income strategy. Second, the hedging techniques they claimed to be using were not only ineffective, they were adding significant costs. And third, the most critical discovery was that the investment strategy itself was fundamentally flawed at its very core. The fund's covered call strategy was, in essence, structurally engineered to fail over any meaningful period. Here's why. Any potential gains were always capped, meaning investors would only ever see a tiny fraction of the upside. But on the other side of the equation, when the fund's assets went down, investors participated in 100% of those losses. It was an unwinnable structure. Section 4. Management under scrutiny. You see, a flawed strategy is one thing, but as the crisis deepened and the losses accelerated, the investor investigation naturally shifted its focus from what was wrong with the fund to who was responsible for it. And the crisis followed a tragically predictable pattern. 4 classic red flags of a death spiral appeared, one right after the other. First, management went completely silent. Second, assets began to drain away as smart money fled. Third, the fund was forced to sell its holdings at a loss just to meet redemption requests and fund payments. The textbook death spiral had officially begun. Section 5. The final crossroads. So, with a broken strategy and a management team in crisis, every single investor arrived at a point of no return. The time for analysis was over. It was now time for a decision. And in that moment, the investor base fractured into 3 distinct groups. The vast majority, 70%, capitulated. They sold to preserve what little capital they had left. 25% held on. And then you have a small contrarian group, just 5%, who actually started buying. The mindset of that majority, the sellers, is captured perfectly here. For them, exiting the position was the only rational choice left. They decided to cut their losses and chalk the whole ordeal up to an expensive but necessary lesson in due diligence. Now, those who held on were often motivated by something else entirely, either simple inertia or the powerful psychological weight of the sunk cost fallacy. For many in this group, the loss had already been mentally accepted, which made taking any further action feel pointless. And finally, we have the true contrarian. This type of investor operates on the principle that the moment of maximum fear, of total chaos, is the ultimate buying signal. They viewed the fund's collapse not as a disaster, but as a potential once-in-a-generation opportunity. Section 6, the unwinnable game. This entire case study, from the initial promise to the final painful choice, leads us to one fundamental and deeply uncomfortable question for all of us as income investors. And that question is this: is the relentless hunt for abnormally high yield ultimately an unwinnable game? By chasing these kinds of strategies, are investors simply setting themselves up for the inevitable and systematic destruction of their capital over the long run? If you found this deep dive into the anatomy of a collapse valuable, and you appreciate this kind of direct, no-nonsense analysis, subscribe to the Finbot Insights channel for more. And please click the like button. It truly helps others find this explainer. We will conclude now with our most important point. This entire presentation has been an educational analysis of a case study. It is not, under any circumstances, financial advice. In the world of investing, you must be your own advocate. You absolutely must conduct your own research. And you must not trust social media influencers, and that explicitly includes this channel.
Because at the end of the day, your money is your responsibility and yours alone.